Welcome to the Passive Investing Made Simple Bootcamp. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And we do this bootcamp live every month to help you learn a critical skill when it comes to passive investing. So maybe you have tried to invest in a passive real estate investment before, but just couldn't quite figure out how to get started in investing. Or maybe you have invested in a deal before and you're like, oops, I made a mistake. I need to figure out my skill set in order to be a better investor. Or simply you are a seasoned investor and you just want to make sure that you have got your I's dotted, your T's crossed, and that you have the most solid skill base that you possibly could have right now. This is the bootcamp where we help you develop those skills to where you can put those in play and turn your active income and savings into passive income and wealth. Now, if we haven't met before, again, my name is Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I invest passively. Me and my crazy crew here, we love spending time together, traveling the world. And it's really my scaling up my real estate investments since 2002 that have allowed me to do that. And I've done so actively and passively. And so I chronicle that journey in my book, Money for Tomorrow, How to Build and Protect Generational Wealth. But really, that book covers over 22 years of my investing history where I've partnered in over 800 million in real estate assets, both actively and passively, and have done over 5 million in flips. And my job here at PassiveInvesting.com is to help you build those skills, that mindset, so you can go into your first or next passive investment with confidence. Now, here's the thing. I've chronicled my entire journey here in Money for Tomorrow, How to Build and Protect Generational Wealth. This is an action guide. If you want to figure out how to be the best passive investor possible, maybe you're starting from scratch, or maybe you have a few deals under your belt already and you want to know what gaps you need to fill, be sure to check this out at biggerpockets.com or even amazon.com. But really, what passive investing has allowed me to do, investing in real estate has allowed me to do, is not only achieve financial freedom, but I find that as a tool. Okay. And that tool of money helps me get 100% control and choice on how I spend my time. Now, I love spending my time here with you. I want you to feel as empowered as I feel in order to build wealth for myself. And we can help you do that here on PassiveInvesting.com, whether it's through our debt investments or through our equity investments. Now, if you haven't done so already, make sure to check out our Passive Investing Club. There you're going to get priority access to all of our open deals. You and I can jump on a one-on-one conversation with each other to discuss your investing goals, and you get additional educational resources like this, like our passive investing boot camps, as well as our weekly master classes. So either scan the QR code you see on your screen or visit passiveinvestingwithwhitney.com. Now, I don't anticipate us going through many numbers, if at all, today. But if we do, whatever I tell you today, it's education. Okay, so make sure you take any education piece, whether that's a webinar or a workshop you attend or a blog you read. Okay, make sure to take that back, sit down with your investment team before you make an investment. Let's figure out how it applies to you. Okay, so, all right. Let's dive in. Let's unlock that offering memorandum. Okay, what is this elusive, beautiful tool that lands in our inbox whenever we have an operator has an investment for you to invest in? Okay, now remember, this offering memorandum, okay, it's a fancy marketing document. Okay, and then it's a key document. Okay, it's going to outline all the objectives, all of the risk of the investment, and it should outline all the terms in the investment and put it in plain language for you. It differs from what we call the private placement memorandum, which is like 100 pages of legalese documentation that will go over the investment as well, and probably some additional disclosures that need to be in place in order for it to qualify under the Exchange Commission's Regulation D exemptions. Okay, but the offering memorandum is really kind of, think of it as a marketing document, a easy to read menu of the investment. Okay, it's going to have different sections to it. It's going to have a financial section. It's going to have a biography section. It's going to have a business plan section and a lot more information in there. But again, remember, this is this is your initial introduction to that investment, and it should create an impression for you for sure. Okay, now what are you going to actually find here? What are all those varying details? Well, everything should point towards the business plan. What is the business plan from closing on the asset, or completing the due diligence, and asset management and asset, and then exiting the asset? What is that end-to-end plan? Okay, so at the beginning, you should have an executive summary. This executive summary is going to be a high-level overview of the deal. Okay, maybe 2 or 3 paragraphs on what the deal is, where it's found, who's running the deal. Okay, a lot of times investors just read the executive summary and then they soft commit to the deal. Okay, there's a ton more information here. Okay, we want to make sure we're reading all that information. And the second key piece of information in the offering memorandum are going to be the financials. Okay, these are going to go over all the key metrics of the deal. It should go over the cash on cash of the deal, the internal rate of return on the deal once it cycles out, the equity multiple of the deal. All right. Then you're going to have the business plan. Okay. What is the operator's initial strategy for the deal? And how are they going to achieve those returns? Now, I say initial because there could be some market changes. There could be some market, not only like global market changes, financial changes, but there could be some local market changes and maybe even law changes or insurance changes that happen on the local level. Okay. But the operator is going to have an initial business plan overview of the deal that they're presenting for you. And it's going to kind of connect the dots. How are we going to get from, buying a piece of property over here or investing in a pool of assets over here and get you your return that you so desire? All right. Now, if this is a hard real estate deal or even a business deal, you should have some sort of market overview. Even if you're investing in, say, a debt fund, that debt fund should have a hypothesis of what markets it's going to go into. All right. So this gives context for the deal's location, the demand drivers, what's going to drive profitability of the deal, what could also be challenges that the deal might experience during the whole time. All right. And then another section of the offering memorandum is going to be the operator's bios, operator or operators bios. Okay, this is the background in the sponsorship team and their track record. Okay, we want to see some sort of track record in that offering memorandum. Now, a pro tip, remember, the offering memorandum is a marketing tool. So of course it should be beautiful and shiny, well organized. We shouldn't have any like typos or grammatical errors. Hopefully it's been proofread. So approach it with a critical eye and don't trust the offering don't go into it blindly. Don't blindly trust the offering memorandum. Okay? The offering memorandum is amazing. We're going to get a ton of information from it, but we still need to read through in between the lines, ask great questions, and complete our due diligence with the private placement memorandum and all the additional paperwork we're going to get. But the offering memorandum is often going to be the only document you're going to get before you need a soft commit on a deal in order to get access to the other key pieces of the deal. Okay, so we want to make sure that we have a good framework to review the offering memorandum, make sure we're asking the right questions, and we want it to be simple. Okay, of course we can make things super complex and super detail oriented, but my job here, what I love doing is presenting you with simple frameworks that are no more than say like 5-6 steps that you can execute on quickly to get to the next stage of investing. All right, so let's understand some of the risks of the offering memorandum. So one, I just want to throw out there is, have you ever felt completely overwhelmed by like even just like a 20-page beautiful document on a deal? Like you're just like, wow, there's so much information in here. There's so many graphs. One, that operator should have their stuff together if they're putting this all together. Two, there's just so much information to go through here. How am I going to figure out what I should be paying attention to? Well, here's the thing. Again, we want to have that framework in place so we're not missing key red flags and, maybe buried data, hidden fees, overly optimistic growth projections, or even maybe like, some way that the operator is bearing, easy for me to say, weak performance of the asset. Okay. We also don't want to fall prey to the hype. Okay. The offering memorandum is meant to hit those emotional triggers for the asset. Okay. It is meant to spark action in you. And we do want to take action, but we want to make sure that we are not letting emotion be the driver. Okay. So the benefits of learning how to execute on my 5-step framework that I'm going to present to you here today is going to allow you to have more confidence as you look at offering memorandums and possibly even protect your wealth and avoid costly mistakes. All right, so I just said, let's not let emotion be the driver here, okay? We want to stay in the driver's seat. It's cool to get excited. It's amazing to have a great deal land in your inbox from one of your favorite operators. Or maybe it's your first deal and you're like, got butterflies in your stomach. But this is when we hit that emotional trigger, that's where investors tend to get in trouble. So one, make sure when you're looking at a deal that you're not operating from FOMO, fear of missing out, okay? There are plenty of deals that will come your way. At some times in the market, certain parts of the market cycle, your inbox is gonna be stuffed so full you don't even know what to do. Then other times in the market, it's gonna be kind of crickets. You're gonna get one every now and then. That's fine. Just know there's plenty of deals out there, and we want to make sure that we are going through the correct steps so we're not operating out of FOMO and emotion. The other way an investor gets in trouble is quite the opposite. They're not so triggered by like, oh my gosh, a deal hit my inbox, I must invest right now. They kind of get a little overconfident. They're like, oh, I've invested with this operator before. I heard great things about the operator, and I took a look at the offering memorandum, just the first 2 or 3 pages. It looks good to me. I'm just gonna, soft commit and get into this deal. Okay, we still have to work the process, work the 5-step framework. So one, we are trusting but verifying. Okay, we want to trust the operator's projections, but we're going to do some verification, make sure that we don't have additional questions that we need to have answered. So again, the solution here: slow down, use a systematic framework like the 5 steps I'm going to offer you today, and focus on the facts. All right, so what is that framework? How do we read an offering memorandum? Well, we got 5 steps, and you can technically do any of these steps in any order, okay? But it's most important that you get all 5 hit. Now, I have a tool for you that you can get in the show notes of this boot camp that will lead you through the 5 steps, some additional questions, some additional pro tips and pointers. And so it's going to take this presentation and really make it come to life for you. So go to the show notes and look for that cheat sheet. But here is my favorite way to execute on these 5 steps. Step number 1, start with the operator. Okay. Again, the operator, once you understand your goals, your risk, and timeline, you've got your investor thesis in place, you need to go find a COO, a chief operating officer that's going to execute on that investment strategy for you. So we got to start with the operator. Okay. What is their track record? What is their team experience? Are they aligned with your interest as an investor in the deal? Okay, so we want to get really good at performing due diligence on the operator. Now, here's the thing. If an offering memorandum has landed in your inbox, hopefully you have already performed due diligence on that operator. Okay, so if you have, great. Let's double check some of our assumptions. Okay, I'm going to get into the second part of step 1. If you have not, this is a great place to pause. Your first step after this is to get on the phone with them. Okay, schedule an appointment as quickly as you possibly can and vet them. Okay, we want to build a relationship with them. Okay, we don't want to get invested in a deal and then build a relationship and then realize, oh no, I did this out of order. Let's get in a relationship first. Let's date them before like we marry them for 5 years in a deal. Okay. So that leads me to the second step. If you've already vetted the operator, this is a great opportunity for you to just do a quick check. Has anything fundamentally changed in their business? Okay, is everything going well with them? Have they executed on a similar deal like what you see in your inbox, or is this their first deal in that area? Okay, if it's their first deal in that particular area, maybe they are introducing a new vertical, or maybe they're going into a new market. Who on the team has that experience, right? Oftentimes there is somebody on the team that has that experience. Dig into the offering memorandum and figure out who that person is. Okay. The second part of the framework for understanding and unlocking this offering memorandum is learning how to evaluate the business plan. Now, again, what we're going over today is not deep due diligence on a deal. That's not what we're trying to do today. I'm trying to help you take this marketing document and be able to pick it apart. Okay, so the part that you're looking for here in this deal or in the offering memorandum is, what is the business plan? Okay, this is where you're probably checking off your due diligence check sheet. Awesome. But we're going to review the strategy. All right, does the strategy for this asset line up with your goals? Okay, if your investing goals are to hold core assets, ones that have no risk of construction or anything like that on them, and the deal is a value add strategy, we've got a mismatch here. All right. Maybe you are the type of person who wants to do development deals and core value add strategy deals. You like the riskier stuff. Okay. And you're looking at a deal that's a class A multifamily deal with, that the only upside is the lease up in your holding. Okay. Right. Like, where does that fit in your portfolio? So make sure you understand the full business plan of the deal. Also understand what market it is in. Okay, so we want to understand the deal, but also the market here as part of the business plan strategy. And again, most importantly, make sure that this aligns with your goals. In the business plan, it's going to be part of the business plan if the deal is intended to kick off cash flow. Maybe you don't want cash flow, you want only equity growth. Okay, I always argue you always want some sort of cash flow, that help de-risk the deal. But maybe you're looking at a deal and it's only equity, it's only upside equity, there's no cash flow for the first 5 years, but you need cash flow. Okay, make sure that business plan is aligned with your investment goals. All right, step number 3. Now we're getting into the financials. And again, this is not a masterclass on due diligence and how what all those terms mean that you see on the screen. We will go over that, and we have gone over it in previous master classes. We will go over those numbers again. But when we look at the financials, we're looking at 2 sets of financials. Okay, one set of financials, we're looking at the actual return that they estimate for it to kick off. The other set of the financials, we're looking at the hurdles of performance. Okay, so let's take bucket number 1 first. We call these key metrics. What type of cash flow is the asset throwing off? Okay, maybe cash flow starts in year 1. Maybe it ramps up in year 3. Okay, understand when the cash flow of the asset is supposed to occur and how that the business plan dictates it will grow over time or anticipates for it to grow over time. Then you've got the internal rate of return. Okay, this is taking into account the exit of the deal and the return of your capital. Once you exit the deal, what is supposed to be your annualized return, or excuse me, not annualized return, but your internal rate of return on your monies invested? Okay, that number is going to help you compare deal to deal to deal, regardless of timeline. Then you're going to get your equity multiple, which if you're going to compare deals based on equity multiple, we need to make sure you're looking at the exact same time length. Like, you cannot take an equity multiple of 3 years and compare it against an equity multiple of 5 years. We want to make sure we're looking at the same timeline, deal to deal. But this is really based on what money you invest. When the deal exit, how many multiples are you expected to get back? Okay. And then we have annualized returns, and then our sensitivity analysis, which we'll go over here in a deeper in our fifth part of the framework. Okay, so those are our key metrics. Those are the actual projected returns on the deal. Then we get into the waterfall. Okay, how does money, who gets paid what and when? All right, those are the second set of numbers that we want to look at. All right, here we're talking about preferred equity. Okay, so if we say on a deal that the preferred equity of this deal is 7%, that just means the first 7% of the return goes to the limited partner investor. Once that's satisfied, then we have what we call additional hurdles in place, like a split or maybe an internal rate of return hurdle that occurs. Maybe there's no preferred equity on the deal at all. And that the operator just does straight splits, maybe 70% to the limited partners, 30% to, 70% to limited partners, 30% to the general partners, and that they call it a day. Or maybe they have other performance hurdles listed in there, okay? That should be disclosed in the offering memorandum. If it's not fully disclosed there, absolutely it should be disclosed in the private placement memorandum, all right? And then we also want to look at the pro forma financials. So that forward-looking projection of like how the income's going to go for the next, say, 5, 7, 10 years. Also, what's going to happen to the expenses for the next 5, 7, 10 years. We want to make sure that the operator is using realistic assumptions in those projections. Why? Because it's going to affect what the returns are in the asset and also our sensitivity analysis, our risk mitigation strategy. Okay. Are all the expenses appropriately accounted for? Are they assuming, if it's a multifamily deal, and are they assuming that rent growth is going to happen at 8% year over year when market really tells us it's only 3% year over year? Okay, we want to check those assumptions, right? So step number 4 is we're going to look at assessing risk. Okay, so we took a look at the operator, we took a look at the business plan, we now have a good understanding in the financials, we took a quick peek at those. Now we're going to understand risk. Now remember, you're checking off your due diligence tools the entire time, but we want to make sure that there is a risk mitigation strategy in place, because not all the time does the first plan work out. If the first exit plan doesn't work out, what is exit plan number 2 or exit plan number 3? Okay, if the operator can't sell, can they refinance? Okay, is there some other way they can keep the deal alive and profitable for you as an investor? So look for contingency plans inside the offering memorandum. Look for the reserves on the asset, both operational and CapEx reserves to be named and dollar amounts to be disclosed. Look for stress testing scenarios, which I'll show you here in a minute. And then also look, hopefully you have this information from your underwriting the operator, but have they been through a tough situation? Do they know how to navigate assets through tough situations? Okay, I would much rather be with an operator that has had to navigate, make some tough calls on assets in the past 2, 3, 4 years than somebody who's remains very untested in this environment. Okay. All right. Step number 5. This is where we're going to get down to our sensitivity analysis and our risk mitigation strategy. Okay, this is where we start kind of like, if you go back to the movie, I'm dating myself, from the 1980s, War Games, like what are all the different strategies that could play out here over the course of the hold, and how does that affect your return? Okay, how does the occupancy and interest rates and all that affect your projected returns? Also, you want to ask, what happens if things don't go as planned? All right. Everybody, what is it? Mike Tyson quote, everybody has a plan until they get punched in the face. Okay, so we want to know what the operators, again, contingency plans are, and have they planned for that and tested those numbers? And so here's kind of, what a sensitivity analysis looks like. You should be looking for a grid like this in the offering memorandum. This grid will, right here, evaluates what the potential returns are at different cap rates, different disposition numbers, and what that particular return is to the investor across time. All right, this framework, this 5-step framework, is meant to be a the first step, not your full due diligence, process, but really just helping you understand what is all that information you can pull out of the offering memorandum to get a large portion of your due diligence done before you actually soft commit to a deal. All right. Remember, the offering memorandum will help you make informed and confident decisions, but it is a marketing tool. Okay. So don't get caught up in the hype of the marketing tool. It's great. I think when I see a beautiful offering memorandum, I know the operator has pride in their deal. I like seeing that, but we want to look at it with a critical eye. So make sure you follow this 5-step framework. Okay. And remember, the offering memorandum is the beginning of your due diligence, not all of your due diligence. We want to make sure that we're taking all of our assumptions we're pulling out of the offering memorandum and verifying them in various webinars, as well as in the private placement memorandum itself. Now, again, I have a free gift for you guys. Make sure you go to the show notes of this episode and pull out your free cheat sheet, 5 steps to unlocking the offering memorandum, a quick guide for passive investors. It's a couple pager that help walk you through this 5-step framework so you can go into your first or next deal with confidence. And if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. Again, so we can hop on a phone call, discuss your investing goals. You can get access to our open deals, and then you get additional educational resources as well. Guys, thank you so much for joining me today. I look forward to helping you in your next deal.